Hi, I'm Jim, and I was retired. So yesterday was Halloween, and I was betwixt and between on how to illustrate this week's topic of Roth conversions. And before I hear any Snickers, let me explain how to reduce the tax bite with Roth conversions. Stay tuned. Now, this topic was actually a request from a new viewer, and I'm going to review a topic that I've visited several times on this channel. I've used my own spreadsheets and online tools to figure out what's the right amount and right approach for Roth conversions. Jer Bear was watching my recent video on how I was retired at 59, and he said he appreciated the perspective. Too few of the channels here on YouTube are focused on the forced early retirement, and I've made that point before. There's a lot focused on financial independence, retire early, and there's a lot focused on standard retirement. But this channel is devoted to those of us that are forced into retirement and now have turned it into a DIY retirement. Now, I replied that I'm going to continue to share the lessons I've learned into my 70s, and I asked what topics he'd like to see. And Jer Bear replied that he'd like to see my thoughts on Roth conversions. And again, I've approached it with my own spreadsheets and a lot of online tools. So I decided to revisit this topic with Halloween on my mind. And by the way, how do I know it's Jer Bear? He told me on his channel. Thank you. Hey, before I go any further, please like and subscribe to this channel and hit the bell if you like entertaining ideas from a DIY retiree. It'll help this channel appear higher in the search algorithm. So I am going to use a Baby Ruth bar, but for this example, let's call it a Baby Roth. So let's assume that you've collected in your trick-or-treating years of working 100 candy bars that represents $1 million retirement portfolio. Now, if you adopt one of those rules of thumb of 4%, then 4% of this pot will be 4 candy bars. Now, keep in mind, a pot of $1 million is going to be divided into taxable, and let's assume it's 15% is taxable. And if you draw your 4 bars from here, you're going to either have 0 if you have good capital gains, or up to 15% if you go over the threshold. So it might make more sense to use this selectively and instead draw from your tax-deferred accounts. And let's assume that represents 75% of this $1 million portfolio, or 75 candy bars. Now, every candy bar you pull from this stash is going to get a tax bite as ordinary income. And if you're in a 12% tax bracket, that means about a 12% tax bite out of each candy bar. Now, if you're like me, you're lucky, and you also have about 10% in Roth accounts, tax-free accounts. Let's move those over there so you can see them. These 10 bars represent your after-tax contributions to a Roth account. And so they've been growing tax-free, and when you withdraw from them, you won't be taxed either. So they are tax-free accounts. How do you build up this stash? So keep in mind that every bar that you draw out of your tax-deferred accounts will be taxed at your current tax rates. And assuming you're in a 12% tax bracket, that's a 12% tax bite. And if you're in the 22% tax bracket, that's a 22% tax bite. So the goal here is to reduce the tax bite from your Roth conversions and your drawing down of assets in the early years of your retirement before full RMD, required minimum distributions, kick in. And the goal here is to max out those candy bars that you're taking out with that 12% tax bracket before it goes into the 22% tax bracket. Now, going back to those 4 bars for the withdrawal of a 4%. Now, if you withdraw all 4 of those bars from your tax-deferred accounts, that represents a tax bite of about 48% out of one of those bars. And then the other 3.5 bars are what you're using to augment any small pension or other ordinary income that you might get in your retirement. This is what you're drawing down, and that's the tax hit that you have to keep in mind with tax-deferred accounts. Now, suppose instead of 4, you withdrew 5 bars from your tax-deferred accounts. The tax bite for 5-bar withdrawals or 50,000 withdrawal from this $1 million portfolio is about 60% of one of those bars. You'd still have nearly 3.5 bars for your expenses, but that 5th bar is one that you could send over to your tax-free accounts with a Roth conversion. Here's a table to illustrate this, leaving candy behind us and putting it into numbers. You had a $1 million portfolio and it had 150,000 in the taxable accounts, 750,000 in the tax deferred, and 100,000 in the tax-free accounts. After withdrawals, the tax deferred is down $50,000. You've drawn out $50,000 from the tax deferred accounts. But one candy bar, $10,000, you've moved over to the tax-free category. So that's grown by $10,000. Now, your taxable represents the $1,200 in taxes you're paying on that Roth conversion, and drawing it out of the taxable account maximizes what you're able to put over in the tax-free account. And again, you could end up paying for it all out of your tax-deferred accounts, or if you are blessed with some good long-term capital gains, you could take more out of your taxable accounts. This just represents paying it with your normal ordinary income in your taxable accounts. But then apply a 7% growth rate to these accounts, and you can see that you're ahead of the game if you get that average return on your accounts. And you will end up with a little bit more than you started with because your accounts are growing in your earlier years of retirement. Now, though, more of your growth is in tax-free accounts, and it'll continue to grow tax-free until you need it. And when you withdraw it from there, you won't be taxed on the withdrawals. You'll save those for later in your retirement. Keep in mind that these are the current tax rates. They expire at the end of 2025 unless Congress renews the 2017 tax cuts. Right now, your tax bite is from 12% to 22% to 24% to 32%. And again, I'm really concentrating on the choice between the 12 and the 22% in my circumstances. You may be in a situation where you want to max out at 22% because you fear what could come in a few years, especially with future tax bites that are bigger. Keep in mind, if they don't renew the tax cuts of 2017, the tax brackets are due to grow. They'll start at 15%, 25%, 28%, or 33%. And if you're anticipating after RMDs or a healthy pension that will start in a few years, getting into those tax brackets, then maxing out at 22% right now may make sense for the next 2 years. But for me, focusing on that 12% is where I'm focusing on my Roth conversion strategy. By the way, on this channel, if you look here, I've done examples like this with another approach of thinking about it as a gallon of water and maximizing the amount you withdraw for those tax-deferred accounts with water. Look at that example. And I've looked at my own spreadsheet, and online tools to help plan for a Roth conversion. You can't do big Roth conversions. The goal is to max out the tax bracket that you're currently in. And if you're in a 12% tax bracket, max it out with additional withdrawals to convert into Roth. If you go into the 22% tax bracket and you want to max out that one, look carefully and do some multi-year planning to make sure it pays off for you. I will conclude with my standard warning. I'm not a professional planner or a tax planner. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.